come through. We also have the WPI data for the month of April, which has come through, and that's come in at an over 8% figure. 8.3% is what it surged to versus 3.88% on a month-on-month basis. The street was working with figures of anywhere between 5 to 6%, so it's come in much higher than what at least the street was anticipating. We have Aditi Nayar, who is the chief economist at ICRA, now joining in to discuss this. Aditi, hi, welcome to the show. Well, we have two pieces of information to ask you. So I'm just going to first ask you about the WPI data, which is coming at around 8.3%. It is obviously the highest that we've seen in many, many months. But was it expected? What is the trajectory now that you expect for the WPI?
In terms of the WPI, we'd actually projected it to come in at 5% in this month. And it's obviously come in much, much higher than that. This is the kind of scale of difference between the forecast and the number is really quite large. I have a feeling that we have to look at some of the, mineral categories, some of the fuel categories. That's probably where the difference lies. So for instance, in natural gas, we had taken a very large jump in this month. It's not an item with a very large weight, but given the kind of movement that we've seen on the natural gas pricing side, perhaps this is one of the reasons that there has been such a large deviation between the expectations and the actual number. And it could be some other categories like this. So for instance, on crude oil, we had looked at the last couple of months numbers after the West Asia crisis started and based our expectation around that. But maybe, some change in the way the actual numbers are calculated. Earlier it used to be quite similar to the Indian basket, which is fixed weight. Now, of course, what we're actually buying would not be in line with the weights in the Indian basket, but realistically looking at where the supplies are available right now. It could be some technical factors like this. So we'll have to really look at the detailed breakup to understand why there is such a large deviation.
It's largely because of fuel and power. This is as per the table that is given by PIB. On a month-on-month basis, fuel and power inflation is up 18.2%. That is the number, and 24.7% if we talk about it overall as well. Aditi, in that case, fuel and power continues to be a matter of concern. What numbers are you factoring in from here on? Could it be higher than 8% because there's no visibility as to when this war would end?
No, you're absolutely right. So, for instance, if you look at fuel and power, within that one of the components is electricity, where there hasn't been too much change. So, for instance, this year the tariff orders that have come through so far, there isn't too much of a change. Even the daily averages that we look at, it's not supportive of this. The other factor is coal, and the third is the mineral oil. So, probably it's the mineral oil index, even without the increase in retail prices of diesel and petrol. It's the other components which are priced, market priced. That's where probably the jump has happened. So, this is what we would need to look at. Now, without having seen today's data, we thought that the May number was going to be higher than the April number, and I suppose that will continue to be the case. So, we'll have to relook at the trajectory now to understand for how many months it would remain above 8%. But given the fact that there's really no visibility for when the war is going to end and how soon commodity prices are going to return to normal, it is going to be difficult to project things like the WPI, which are very much, very heavily weighted towards internationally traded commodities. And of course, the INR depreciation is another factor that exacerbates the landed price of imported commodities. So that's another factor that we have to keep in mind.
Absolutely, the INR depreciation, that's what I wanted to understand as well, right? Because when you see it hitting new lows, what are we keeping an eye out on now, even from the central bank side, RBI side? Inflation, you said you cannot judge the numbers. So what is the central bank, maybe the decision that maybe we could keep an eye out on now?
I mean, we'll have to make projections, even though obviously data is limited and, visibility is not there into what geopolitics will look like next week or next month. We will be making our forecasts based on the information which is available. And, we'll obviously have to rework, given the fact that there has been such a big gap this month. We'll have to relook at our forecasts for the next few months. So, if we come in at 8.3% for April, I would imagine May will be higher than that. But will it be, around 9% or higher than that? We'll have to kind of really take a look. Now, in terms of the central bank, we do have the MPC review next month. There is still a few weeks between now and the MPC review, and the world could change. We don't know how things will really end up being. But my sense is that at least this time around, since the CPI inflation was much more benign than what had been expected, and that's not really showing an impact of the West Asia crisis too much so far. Maybe we could still end up with a pause in the June policy review, and it will be a very policy by policy kind of decision given the kind of flux which exists right now.
Okay, yes, absolutely, definitely moving parts, Aditi, because there's a Bloomberg report right now which is saying that government is considering reducing taxes on foreign holdings in debt. Have you looked at that space at all? When you talk to clients, what do they say from the foreign investment point of view when it comes to debt holdings at this point? What kind of tax changes should we possibly expect? And what do you think that would possibly do to the rupee?
I don't want to speculate on what may or may not come in this space, but I think as far as the rupee is concerned, we do have a challenging situation between the uncertainties on the global side and what is happening as far as FIIs are concerned, and also the overall balance of payments. So, for instance, last year we probably ended up with a current account deficit of 0.9% of GDP. And this year, if we now work with the assumption that crude oil price will average $95 per barrel for the full year, which means that it will remain where it is for the next few months and then eventually drop down to $80 per barrel after the war sort of settles. Then at $95 per barrel average for the full year, we are still looking at a current account deficit which is going to be a little higher than 2% of GDP for FY27. And that's like more than double of the level that we had last year. So it is going to be a challenging situation for the balance of payments. We will need to find ways to attract more financial flows to be able to offset the current account deficit, which is expected to be, 2% of GDP at present.
Okay, take that point. Aditi, thank you so much for joining us for insights. It's a developing situation. So of course, a lot of these forecasts depend on a lot of changes that keep happening. Thank you for your thoughts today. With that, let's move on.